Good evening. Welcome to Money Matters. I'm Charlie Shields, Wells Fargo Advisors, LLC. My co-host is Chuck Steege, Certified Financial Planner with SFG Advisors. How you doing, Chuck?
Good to see you.
Our special guest tonight is Bruce Lipnick, Chairman of Asset Alliance Corp. He's an entrepreneur who does crowdfunding and other sources of funding. So I think it's going to be a fun show. Stick with us. Okay, Chuck, let's talk a little bit about, I want to remind our viewers and listeners that we're not attorneys, we're not accountants. We're here to give them advice. Don't market time based on anything we say, because we try to give advice for the long run. So having said that, you're a specialist in the area of public company executive stock-based compensation. Tell our viewers and listeners what that means.
So what it means is that we assist senior level corporate executives of public companies primarily to determine how they can navigate towards financial peace of mind. We specifically specialize in providing stock-based compensation planning, and for a senior level executive in the public space, they have enormous complexity to their situation, whether it's dealing with taxes or compliance or the economics of divestiture planning. So it's pretty complex and involved.
And for our viewers and listeners who don't realize how many players are involved when you're working this stuff, you have the stockholders, you have activist investors who can get upset if things aren't done right. You have to be fair to everyone, right, to make sure that you're doing your job.
Exactly correct. And certainly you have proxy advisors that are, and institutional investors, and many of them are watching very closely executive pay. Increasingly more scrutiny around various forms of executive compensation.
What is the trend in 2015? The market's been going up several years, so are things getting better for CEOs now, or level, or how would you describe it?
Well, we've certainly seen a trend up since 2013, and we expect that that will continue into 2015. Short-term compensation targets, percentages based on salaries are pretty much in line with what we've seen in 2014, but the trend appears to be increasing upward. It's more about the long-term incentive that is taking focus, not so much short-term, i.e. salary, bonuses, but more around various forms of stock-based compensation, whether it's restricted stock, whether it's performance stock units, whether it is stock options. There's much more attention being given to long-term incentive pay.
Just to try to put a real situation out here, one of my friends, and I told him we were going to do the show tonight, he said, ask him, how do you do this trade-off between nobody deserves more than 40 times what the average worker's making in a company versus this CEO created $1 billion, so of course he deserves, some huge amount of money. How do you do that trade-off?
Well, I mean, obviously that's you get a variety of perspectives on that based on who's looking through the lens. There's an enormous amount of responsibility that a CEO has around the future of that enterprise. And if you were to look at the value of the company and the revenues that are generated relative to what a CEO's compensation is, it's still a relatively small percentage of pay versus the amount of revenues that are generated. So, you're really hiring the best and the brightest into these roles. And of course, the shareholders want people that are smart and can take the business to a higher level.
Sure. How do you structure the compensation so that if someone comes in with very high expectations and they let everyone down and the stock gets cut by 70%, the CEO doesn't get that huge reward and walk away and say, sorry, it didn't work. In 2008, there was a lot of that. So
Sure. Well, there's much more emphasis on, for instance, total shareholder return, where certain targets are expected to be met. And if a company's stock price performs relative to its peer group based on target, then maybe that executive will receive 100% of a particular grant that was awarded to them. Again, it's performance driven. There are performance metrics around this. And if those metrics aren't met, or there's a minimum amount that was realized, well, then there's certainly the CEO isn't going to receive as much. So, so there's clearly a move, the direction of performance-based awards that are really tied to stock-based performance.
Okay. A lot of our viewers and listeners are used to vesting, where they come to work for a company and they have to, the money gets put in by the company and they have to wait so many years before they're eligible for it. Do you use vesting for CEOs and CFOs in your structure of compensation?
Well, most times it's the board's compensation committee that is determining how the vesting is going to be structured for the various types of awards. But vesting is clearly it's clearly a means by which an executive then legally has a right to the shares. But that's kind of changing. With 2015, there's clearly a move afoot to require executives to hold for a period of time, even after vesting, or even after an exercise, for instance, if it's a stock option.
Otherwise, the people out there that are investing in a stock, if they know the CEO's made a ton of money and he might be selling it the day after he quits, and he hears that they hear that he's leaving, then there might be a big drop in the stock because of this.
Well, those prohibitions are going in place. And in some cases, the prohibition to sell a position could be as much as 2 years beyond vest.
Okay.
And in some cases, it could be that the CEO or a named executive officer can't actually divest until, let's say, retirement.
Yeah, and even if they've earned some stock during their tenure, I'm sure it's restricted stock in a lot of cases. So it's not just whatever they vested, but even if they're paid in stock, it's usually restricted, correct? So
Absolutely.
They can't sell. Yeah.
Well, there's certainly a mix of how executives are being compensated. And by the way, shareholders are getting a lot smarter because the companies are communicating increasingly with shareholder groups. That was the one thing that we saw in 2014 that we expect to continue into 2015, and that is that companies are reaching out to the investor communities, and they're gaining tremendous acceptance on the part of shareholders. So for instance, Say on Pay has received an enormously favorable response when companies put out to their shareholders the approval of executive compensation plans. In 2014, 98% of the 3,200 companies that one consulting firm evaluated actually received a favorable Say on Pay vote from the shareholder groups. And why is that? Well, it's because that it's not, an executive is not receiving simply stock options or restricted stocks, which tend to be more time-based, but rather there's a move towards performance-based awards, where those awards will only vest either as a result of a financial metric being met or as a result of strategy having been properly executed.
Okay. Since this is also a show about the stock market and the bond market, do you have any questions you want to ask me?
Absolutely. So based on our discussion, Charlie, with regards to executive compensation, what are your thoughts about how you expect the market's going to perform?
Well, I believe that it's going to be more of a stock picker's market. People that own the S&P index have had a lot of fun for the last 4 years, and I believe we're going to get to a point here where, with the dollar rallying and interest rates around the world being very low, and overseas stocks selling at 10 or 11 times earnings and U.S. stocks at 17 times earnings, I think it might be a good time for people who've had a nice ride buying the S&P 500 to take a look at other places to invest. And so even though Europe is a basket case right now, and we don't want to time this show, but there are potential steps being taken in the very near future to try to stimulate their economy. Ironically, in the U.S., we did these things that the Europeans are considering doing several years ago, but we did it when interest rates are high. And interest rates over in Europe are already low, so I'm not sure what this stimulus is going to do. This is going to be an interesting experiment. But I would, if I were an investor who had a lot of blue chip stocks in the U.S., especially overseas companies that do business overseas, I would be looking to trim those. That's one thing I'll throw out there.
So trim the European stock positions?
Let's take stocks that have gone to 20 or 22 times earnings, Colgate or that type of a stock. The defensive investing in the U.S. has driven those stocks to very high multiples. Whereas if you looked at a similar stock over in Europe, it might be trading at 12 times earnings. And in general, those alligator jaws will close, where the 20 PE and the 12 PE will come together. So I would be trimming some of those kind of stocks, and I'd be looking for similar types of stocks overseas.
So there's certainly been a nice long bull run. Do you expect that bull run will continue in the U.S.?
Well, we've had a revision to the mean is one way of looking at that. We had a crash in 2008, and then the Fed made all this money available. They didn't put our government in Washington didn't put the other procedures in place, put too much regulation and that sort of thing into place. So instead of that money going into shovel-ready projects that we heard about, it went sloshing over into stocks and bonds. So now it's time for Washington to get their act together. You tell me whether the new Senate and House are going to work with the president better than they have, and I'll tell you whether or not our stock market's going to go up. But it bears watching.
So you mentioned interest rates and some of the tools that have been implemented. Annuity rates, what are your thoughts about them at this point?
Well, I don't like annuities generally. They have very high costs and that sort of thing, but some people are now starting to substitute the income you can get from an annuity. They're substituting those for bonds. And there's reasons not to do that. I don't want to give people an opinion on an annuity. They should go talk to their own advisor. But that is one place people are chasing yield, and that's one place they're doing it. So I think we should try to get our other guest involved. So let's try to go ahead and answer the one question that came in first. Joyce Thomas of Malvern says, how do you see salary increases developing over the next few years?
Okay, well, I think that question can be answered in a few ways. The first is for the general population, and then secondly, to address it from an executive's perspective. So in 2014, for instance, an executive's compensation structure increased about 4%. We expect that will be about the same as we go into 2015. We don't see that momentum shifting a whole lot. With regards to the general population, we haven't really seen wage inflation. We haven't seen a demand for higher income that's pushed inflation up. So I think the jury is out a little bit on that.
Okay.
So there's still a little bit of uncertainty. We have a lot of slack in the labor market. We have a lot of people who, if they didn't fall out of the labor rolls, they are looking for work at this point.
Okay. Well, thanks for answering that question. If you viewers and listeners have a question, please send it in. We're going to tell you how to do that right now.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, matters, M-A-T-T-E-R-S, TV.com.
Okay, well now we'll have the special part of our show. Bruce Lipnick, thanks for coming in today. Appreciate it very much.
Thank you, Charlie, for having me down here.
So why don't you talk to us about how your 40 years of success on Wall Street has brought us to our show today?
It makes a pain in my heart when you say that, 40 years. Yeah, I've been in the alternative space or hedge fund business or hedging business since 1960, actually longer than 40 years, 69 right now.
Wow.
I started out managing money for a wealthy family before there were family offices, basically by doing an option writing program against a low-cost stock before the CBOE started in '73.
Wow.
And I just kept going, basically. Recently, not recently, but 1996, I founded the company I'm with now, Asset Alliance, and our focus was to buy interest in hedge funds and seed hedge funds, because the hedge fund business was expanding dramatically in the 90s.
Yeah.
We then opened up the first 40 Act fund, mutual fund, to invest in hedge fund type strategies in 2002. Now there's probably 100 funds out there with several $100 billion, but we were the first ones to do that. I try to be first in disruptive type products. We actually started that with $10 million and we just sold it. It has about $1.8 billion in it right now. We sold it to a public company.
That's exciting.
And I'm now moving the company more toward the internet with some new products, disruptive and next generation products, which I can take you through if you like.
So Bruce, talk to us a little bit about Crowd Alliance,
Okay.
which is the enterprise that you've established, and how that fund fits in with your hedge fund strategy.
Okay, as Charlie mentioned, rates are pretty low, and they've been low, and they'll probably continue to be low. And a lot of people are living off bonds, CDs, and treasury accounts, money market accounts, and making nothing after taxes and inflation. So we see an opportunity to crowdfund not only disruptive companies and technology, but also real estate. We have a lot of family offices in Europe bringing a lot of capital over to the United States, and they want to invest in real estate. But for the general public, we're going to have products or cash flowing buildings on our site, crowdfunding site, where people can come, look at all the due diligence, look at all the information about it, and click and say, I'd like to buy a piece of that building, and get a cash flow paid monthly to them, as well as some potential earn out when we sell the building, if we sell the building.
So what kind of cash flow percentages are we typically?
We're focusing on between 4 to 6%, which is substantially higher than what's out there right now in banks and money market funds. And then eventually, if we sell a building or monetize it, it could be as high as 10%.
So crowdfunding is for the little guy, so those people don't have to be accredited investors?
Well,
Am I wrong or right?
You're wrong right now. The Title II is for accredited investors. They're still working on Title III. You mentioned about Washington, D.C.
Yeah.
Washington, D.C. does nothing and may not do nothing for a couple of years, unfortunately. And Title III is supposed to come out in 2016, allowing the non-accredited investor to invest. But we'll see how long it takes.
Good. Well, tell us about some of your other investments that you find interesting right now.
Okay. We just launched the next generation liquid hedge fund platform about a week ago. And what it does is it answers every concern investors have investing in hedge funds. And what we've done is we've taken out, for example, the money stays in your brokerage account, never goes into the hedge fund. So there's no chance of stealing money, there's no gating, there's no theft, there's no fraud potential, because it never leaves your account. What it is, we've coded and replicated the hedge funds on our platform. Every trade in 30 milliseconds goes to your account, broken up by your capital. So the hedge fund may buy something for 10,000 shares. Because your account is smaller, you might have 100 shares in the same stock. But what it does, it opens it up to the REA world and the mutual fund world to have active management from great hedge funds without the worries of getting your money back, liquidity. You can get out every second. There's no K1s, you get a 1099, and you can't tell me one hedge fund in the world that you can stop loss, because you don't know what's in there.
Yeah.
Here, In a couple of months, we're going to have stop-loss positions because you can get out of everything instantly.
Wow.
So the money can never be affected by anything outside of performance, basically.
Mm-hmm.
So it's
Do you
revolutionary.
think 2% plus 20% of the gains is going to be around for the long
Well,
haul?
we charge no incentive fees. We have a flat fee.
Okay.
So we've taken out that risk. There's no cost for accounting. There's no cost for administration. Because remember, the money stays in your account.
Yeah.
An Interactive Broker, Fidelity, and Pershing.
Okay.
So that's one of the products.
So Bruce, most crowdfunding, when you think of it, is technology company focused.
Food, technology, yes.
Yeah, you're focusing on real estate. Why?
Well, as I said before, there's a big demand for yield, and there's no yields out there. And, you know, how do you match up the product with the investor? It's very hard for the average investor, whether he's a big investor, small investor, to find the right investment in real estate. So we'll have a site where they can go online and analyze it themselves, or their advisor analyze it, and they can say, I want to take a piece of that company, but they have to be an accredited investor right now.
So that answered my question, and that is, what type of investor is most ideal for Crowd Alliance?
It's going to be, as I said before, accredited investors. It's going to be people from family offices, high net worth, REAs are signing on with us right now.
Okay.
Yeah.
So I'm interested in what you see for the future of this crowd fund investing once Washington gets off the dime.
Okay.
And also, what do you think, are the costs going to be driven down because people like you are coming in, and these guys that are 2 and 20 going to be dinosaurs in the future? What's your prediction?
Well, you're talking about hedge fund business versus crowdfunding?
Yeah.
The crowdfunding, it's very crowded right now.
Yeah.
There's a lot of sites up there, and a lot of them are going to go away. In most new businesses, things consolidate over time. And being from the performance end of the world, in the hedge fund world, if you don't make money for these people that they invest in these companies, they're going away.
Yeah.
And it's just a matter of time for a lot of these companies, if they don't monetize or take something public, they're going to leave those sites and go somewhere else.
Yeah.
On the 2 and 20 thought, what we do is very liquid securities, long short equity, biased short side or long side, commodities and options. If you want something that's structured product or bonds or something, you might still have a 2 and 20 because it's a unique type strategy. But what we're trying to do is monetize it and bring the cost down to the average investor or the REA investor
Okay.
over time.
So let me go back to hedge funds for
Okay.
a minute. I mean, there's certainly been a lot of changes in this space, right? So what in particular excites you the most about hedge fund investing?
Well, you generally get, I don't want to say the smartest people because you can lose money in hedge funds, obviously. But you have very unique investors that want to be in something that's unique. And that's been the hedge fund business since the beginning. I think it's going to change. It's a very mature business now. It's become mainstream. Most of the money is going to the top 20, 30 hedge funds from institutions. We're going to change that because on our site, you don't have to be an accredited investor. You can put in $30,000 and you can mimic a $1 billion hedge fund. This has never been done before. We started it last week. We've already raised from REA's people $150 million, and we expect to have billions over the next several years on the site.
And I appreciate you asking about or mentioning the RIAs. The hedge fund industry has certainly been under a lot of regulatory.
Sure.
How do you see that changing?
I don't see that changing. I think, as you said before, the country is very compliance moving towards right now. FINRA is all over everything that's going on, which is a little extreme. I think the Dodd-Frank bill is very extreme. I'm very good friends with Senator Dodd. And it's 2,900 pages where the Declaration of Independence is 1 page. You know, so you can see how complicated things have gotten in Washington. And that's got to change. If we're going to be competitive around the world, it's got to change. And we'll see what happens, yeah. So.
Talk to us a couple of minutes about asset allocation. How do you guys decide where you want to go next? Do you try to find the out of favor manager sectors and bring a manager in who's
for the platform?
For the platforms.
The platform, basically, we're looking for managers that have a very consistent track record. They don't have to be 25% a year manager, because that's very difficult. If you make 25%, you probably can lose 25%. So we're looking for consistent managers that have a good track record of hedging in down markets. And the beauty of the platform, is that you can see every day, tick by tick, how you're tracking against an index. So you'll know if the guy is style drifting, you see every position, so you can get out very quickly if you don't like what he's doing.
So in general, let's suppose you have 10 managers, you just asset allocate to them?
Well, that's up
and
to the
reallocate?
RIA. We don't do it for the client.
Okay.
He comes online and says, I like those 10 managers. He can allocate anywhere he wants. You can leverage it down.
Okay.
You can leverage it up.
And do you decide whether you're going to bring in a new manager and fire another one? Or,
Sure.
So, and that's just under performance?
Well, no, it's on due diligence as well. We have a constant upgrading on seeing what, if somebody leaves the firm or something like that, it goes on their own. It's very transparent, extremely transparent, probably more than people have ever seen. So we've leveled the playing field for the average investor against the institution. So he probably has more advantage than an institution. So.
Okay. Anything else?
No?
All right, well, I'd just like to get a little bit of, for about a minute here, a little transition from your history. In 45 years, you've seen a lot of things happen. And, 2008, 2000, we had those big crashes. Do you expect, based on your years of experience, that we could see another one of those in the next 5 years? You think we'll be safe for a while because everybody's nervous?
I think absolutely we'll see another crash again.
Yeah,
Always
who knows
does. Everything
when.
cycles, and depends how big it's going to be. Like you said before, the banks in Washington did nothing basically to really protect things, and there's a lot of big institutions out there, and we're so tied into the rest of the world that events can trigger things. I think the internet is great, but it's also dangerous because so much information hits you at once, and people react so fast without even thinking because of news they hear. So we'll have a lot of volatility going forward, in my opinion.
One other quick one. You have an opinion on this high-frequency trading where the market went down 1,000, back up 700? You think that's getting fixed?
I think that's, I don't want to say it's over because people are still doing it, but the SEC is watching it, FINRA is watching it, and I think it's not going to be as important as it was before.
Well, we really appreciate you
Sure.
coming from New York to do the show, Bruce. Thank
My
you
pleasure.
so much.
I'll be back if you want me.
Great, thank you. Okay, so our next guest is going to be Mike Deaver, Brandywine Asset Management, and that's a boutique manager in the Philadelphia area, and they'll put on a real interesting show. Hope you'll join us next week. As far as we're concerned, your money matters.